Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video I have been putting this off as long as I can because I don't like losing money. But at some point you have to bite the bullet and you either have to take the loss or you can be stubborn and try to salvage a losing position, which I don't like doing. I would much rather get out of the losing trade and just start over, do a refresh, do a reset, like Control Alternate Delete. So let's go ahead and get into this. So I closed out my spread, my option spread with Microsoft, and let's go to the transactions here and let's put in Microsoft like this so that you can see all of the fun that I've had the last few months. And let's go to February and let's see how long this takes to load up here. Okay, here we go. So back on February the 4th, I entered Microsoft and I started trading options, and I was doing option spreads, I was doing diagonal spreads, and I started out buying a 105 call for $1,600, and then I started selling to open weekly calls. So, made money there, bought it back, made money there, and then had to start rolling it up. And then eventually I bought some puts because I thought Microsoft was going to go back down, and I ended up selling the call. And get this, okay, this 105 call that I bought to open, somewhere down here, I sold to close the spread, that call spread, and I lost money on the call spread, which I will explain here in a minute after I get done talking about all this. So if you're really bored and you have nothing better to do, you can go ahead and pause the video and scroll through this. You can add up all the green numbers and then add up all those red numbers and take the red total and subtract that from the green total, and you will get a negative $1,067.83. That's how much money I lost since February the 4th. That's when I opened the trade, and on May the 10th, that's when I closed the trade. So that's about a 3% loss for me. Not quite 3%, maybe 2.8% loss for me, because I do have how much? Let's see, how much do I have? Let's go to my positions here. And so I do have all that money, right? So it's about almost a 3% loss on that trade in the last 3 months. So it's not like a crushing loss for me. But let's go back to the transactions, and let me finish telling this really sad story on why I lost money on this spread here. So it would have been on February, and here it is right there. And so I started out with a 105, and then I eventually bought to open two put options. I bought to open this 115 put right there, and then I bought to open a 110 put, and the 115 put cost me $14.50. The 110 cost me $1,400, and I was selling to open the long puts, and the long call were leaps. They expired in January of 2021, and I was selling to open weekly puts, sometimes 2 or 3 weeks out, to try to pay off those puts and the calls. And now let's go to the chart, and let me show you what happened and why I got into such trouble here. So February the 4th would have been right about this part right here, okay, and that's when I bought the 105 call, and then it went down a little bit, and that's when I sold my next call, and I started out good, and then it went up here. And if we go to a longer chart here, okay, like look at the year, okay, Microsoft was not anymore, but it was a ranging stock, right? It was going up and down like clockwork, right? And then Microsoft decided to do something it's never done before. It broke its 52-week high, went all the way up to $130 a share, and that's when I started having trouble. Now, here is the key ingredient that I really want to bring home here, okay? Now, when you start trading option spreads, you're buying calls and you're selling calls, or you're buying puts and you're selling puts. If you're buying a call and selling a put, that's not a spread. If you're buying a call and you're buying puts, that's not a spread. That's actually called a strangle or a straddle, but you never say straddle spread or strangle spread. It's just a strangle, it's just a straddle, right? A spread is when you buy to open a call and you sell to open a call. That's a spread, okay? And when you buy and sell those calls or puts, you can do puts or calls. They're either going to have different expiration dates, they're going to have different strike prices, or both. If it's different strikes, it's a vertical spread. Different expiration is horizontal spread. And when both of them are different, that's a diagonal spread. But you don't have to get hung up on all that vocabulary. Just know that when you're doing a spread, you're buying a call or you're buying a put, and then you're selling a put and you're selling a call to try to limit your risk. Maybe you want to sell a lower call and buy a higher call, or maybe you want to buy a lower call and sell a higher call if you think the stock's going to go up, right? But the way that I've been doing the spreads is I've been buying calls and also puts that expire in a long time, like a year from now or 2 years from now, and then I've been selling the open calls and puts that expires in a week or maybe 2 or 3 weeks. So the spread is very wide. Now, here's the key element here. When you're doing option spreads and the spreads are really wide like that, okay, delta is not your friend. Delta and the money that you can make on the theta is great. Okay, the theta is the time value of the options, right? You can make tremendous money. And let me show you what I mean, okay? Let's go ahead and look at Microsoft, and let's look at the option chain. And right now, Microsoft is at 127.13. So let's say you're going to do one of these wide spreads. You'd look at a call maybe, and let's say let's go to January, okay? So 614 days. This is May 12, 2019, so that's about 1 year and 3 quarters. Not quite 2 years, it's about 20 months, 614 days. And let's say that you wanted to buy this leap call, expires of January 2021, and let's say you get the 130 call, okay? 1430 is the bid, 1565 is the ask, so let's say you spend 1500 for that call. Now, if we go to like one of the short-term calls, like let's go out 12 days, okay? Notice in 12 days, you can make $80. So that's about $300. Nope, not that much. 80 times 3 is 240. So let's say you're making $200 a month, okay? Now, you spent $1,500 for that call. But if you're making $200 a month, in 10 months, you've made $2,000. That's a $500 profit, right? So the theta is great. But the problem is, what happens if the stock goes up or down and it's doing all this nonsense? Then you get in trouble, okay? Now, let me show you on the option chain why you get in so much trouble, okay? So, first of all, let's go to the option Greeks like this. And let's look at the delta. Now, delta, these are all option Greeks. Delta tells you how much the call or the put is going to go up or down in value as the stock goes up or down in value. So that 130 call, June 8, I'm sorry, I clicked on the wrong month. Okay, here we go, January of 2021. That 130 call has a 54 delta, okay? So that means that if Microsoft goes up $1, this 130 call is going to go up $54. And each call option counts as 100 shares. So you're making $54 on the call, right? So that's pretty cool, right? Now, let's say that the stock goes up a lot, like what happened to me, okay? And let me tell you something. It doesn't matter if you have a call spread. It doesn't matter if you have a put spread. And it doesn't matter which way the stock goes. When the spread is really wide, and you're buying the leaps, and you're selling the open weeklies or the monthlies, you're going to lose money if the stock does all of this, and it's making these big moves, okay? Now remember, I entered the spread back on February the 4th, right, which would have been like right around there somewhere. And so that was when Microsoft's at 105, and then went all the way up to where you see it now, 127. So that's that's like a 20% increase in Microsoft, which is crazy, okay? And it just goes to show, you know, sometimes things don't always go as planned. Microsoft has always been a nice tame stock, but no more. You know, it's going up a lot, and so this particular strategy didn't work for me. And so let me go back to the option chain and let's look at an in the money call here. So let's go to in the money like this, okay? And now let's look at the 105 call. That's the call that I used to own. That's the call right there. And oops, I clicked on the wrong month again. Let's go to January like that. And let's look at the delta. So there's a delta. And the delta, even though Microsoft is all the way up to 127.20, that's what, $22 in the money. You're still looking at a $77 delta. Okay. Now, let's look at a short-term call. Okay. And let me show you how the delta cancels out any possibility of making money. So whatever money you make selling the open calls, delta will take it right back if the stock is moving a lot like it's been doing. So let's go to May the 17th right here, and let's look at let's see how far up we have to go until we find a 77 delta. So here it is. There's an 82 delta, and so the first time we get a delta that's lower than that call is 125. Okay, so I had the 105 leap call, and that was a 77 delta, and now it's showing a 1, right? And I was selling to open. If we went back to my transactions here, and we'll go back to Microsoft here and click on February. Okay. Here it is right there. So I was selling to open. I started out with a 106 call, and then I sold a 105 call, and here I sold a 110 call, and then that's the second call that I bought. I sold a 111 call. Here's a 107 call that I sold. Here's a 112 call that I sold. And so I kept having to hit higher and higher strike prices because Microsoft kept going up, up, and up. And here's a one that I really want to find the call where I closed it out. Here's a 110. Is that the one? No. I should have did a little bit more preparation before I did this video here. Is this the one? I think, okay, here's a 110 call. Looks like I bought it to close. So where's that 110? Here it is right here. So 502 that I bought to. So here's the call that I sold to open for 502, and look what I had to buy it to close when I was ready to get out. Okay, so that was a 110. I had to buy to close it for 937, right? And so because it was a short call, then that is a $437 debit, like a $430 in the red debit that I had to take. So even though I bought this call for $1,600 and I got out for $2,300, I took in so many of these red numbers, so many of these debits, because Microsoft kept going up and the delta was hurting me. So if we go back to the delta, right, imagine if right now, okay, right now Microsoft is at 127. Imagine if right now you had this 105 call, okay, and here's the 105 call right there, and it has a delta of 75. So just think if you had that call right now, okay, and you were doing this diagonal spread strategy, and you were selling to open calls for, I don't know, however many weeks or months, right? And you might have been selling the 110s or the 115s or even the 120s, okay? If we look at the expiration, actually, let's even go out a further week. Let's go out to May 24th, okay? And let's see where we can find a 75 delta here. So this is the delta column right there, right there. And so where do we find a 75 delta? We have to go all the way to $124. So what strike price are you going to sell to open to try to equalize that 75 delta? And it would have to be a 105, 120. That's what, $19 out of the money. Okay. Now imagine if you were to buy a call right now, and then you were to sell to open a call option. So let's say you were to buy a call, a near the money call. You were going to buy to open this call, and let's go to the regular option chain and let's take a look, and let's go ahead and look at the near the money call option. And come on, work for me. Okay, let me try to reset here. Let me try a reset here. It's going real slow for me. Let me go back to Microsoft and pull up an option chain like this. We're going to take a look at the leap call here. Okay, so here we go. So let's go ahead and do a 125. We'll even go a little bit in the money. So let's say you spend $1,700, right? The bid is $1,680. The ask is $1,750. So let's say $1,700. Now let's look at the calls that are $19 out of the money. And let's say we were even going to, and let's start by looking at the weeklies. Let's go 12 days out. So that means we'll go up to what, 145 or 140 even. And let's take a look at how much you could get for those call options. And these are calls that expire in 12 days. And let's say you bought that 125. You get nothing. You get zero. The bid is $0. The ask is $4. So that's not even that's not even an option. I mean, so that's the problem. Okay, so you are forced to sell these lower strike price calls, and the lower you go on the strike prices, the higher is the delta. Okay, so let's go back to our option Greeks here, like this, and let's go to the May 24th calls, and notice how the delta is really small, like for a 150, and then it starts to go up. As we go up and we get to like a 128 call, we're dealing with a 44 delta. Okay, now if we go in the money, okay, then the delta is going to go higher than 75. So here's a 124 call, and so already you're $1 in the money, right? You bought to open the leap, and you're selling to open a 124, and that's the first time where you actually get a higher delta, right? So Microsoft barely has to move, and already the delta on your short call is higher than the delta on your long call, and you do not want that, because the problem when that happens is that, let's say that you had this 125 call, and for some reason you had a 124 call. That means for every dollar that Microsoft goes up, you make $75, but you lose $82. So that creates a net loss for every dollar it goes up. And that delta is going to increase too. And gamma tells you how much that's going to increase. So the higher it goes, the more trouble that you have in trying to keep up. And so that's the problem that I was having. So if we go back to the chart here, you know, let me clear all this out, and let's go to a 3-month chart because it's easier. Actually, let's go to a 6-month chart since it's been longer than 3 months. And let's look at the chart here. So February the 4th, this is where I bought it. And this is what I have been dealing with all of this time. It's just been going up, up, and up. Okay, and the delta, I've been getting burned by this higher and higher delta on these short calls, and that has really got me into some trouble. And that's not something that I fully understood, because I trade option callers. I actually started out trading covered calls, selling covered calls, and with a covered call you don't have this problem because you own the stock, and stocks don't have a delta. If it goes up $1, you make $1. So you buy 100 shares, you're always going to make money. On a caller, you're always going to make money when you sell covered calls if the stock goes up. But when you're doing spreads, that is not the case, because when you do a spread, you are buying call options, and calls have delta. Stocks do not have delta, and that's why you can get into trouble. And when you're doing the really far wide spreads, you can get in a lot of trouble. Now, the standard way that people trade spreads is they pick the same expiration date, and had I would have done that, I'd have no trouble at all, right? And that's known as a debit spread or a bull call spread. And on Ameritrade, you can actually click on this and put vertical call spread. Remember, vertical means strike price, and you can go like this, and it gives you a like a kind of a one trade in all order here. And then you can click on those. And so let's say we went out 40 days. And so here it shows bear call, and here it shows bull call, right? So if I would have been doing bull calls, then I would not be in the situation that I'm in right now. But I did these diagonal spreads, and I was buying these long-term leaps and selling these short-term calls, and that's why I had trouble. But if we look at the bull call here, okay, and let's say that I was going to put in an order for, I don't know, let's say a $5 spread here. Let's say right now I wanted to buy the 125 and sell the 130. And the bid is showing 250, the ask is showing 275. So that's the spread within this $5 gap, okay? Now you don't have to get all confused about that. Just know that you're buying this 125 call and you're going to sell this 130 call. The 125 call, it's got it listed over here on the left, and the 130 call is over on the right. So what you would do is you would pay, the bid is 470, the ask is 485. So let's say 480 for the 125 call, and then you would sell the 130 call, and you would receive the bid is 210, the ask is 220. So let's say 215. So you're spending 480, and then you get back 215. Now, if Microsoft indeed does go up to $130 or higher, then this 125 call, 130 minus 125 will be worth $5, which you only spent 280, right? So your $280 will turn into $500, and then this call will be worth $0 if it stops at 130, right? So basically, you'll make a very good profit. Your $280 will turn into $500, and that's almost doubling your money. You're spending $280, and you're making $500. 500 minus 280 is $220. You're making $220. If I would have been doing that on Microsoft, then I would be much better off. But I didn't do that because I did not understand the problem with a delta that you have when you do these diagonal spreads, and the spreads are really far out. So as you see, as Microsoft kept going up, I should have shape-shifted into a different strategy. I should have started doing those bull call spreads, or maybe even some ratio spreads. I could have just bought an extra call, and then I could just hold on to those other calls and roll them up until Microsoft decides to start going down. But I was under the delusion that as long as it goes up, I'm good to go. But I wasn't good to go, and I lost money on that call. I lost, I think it was $146 on that call spread, and when I noticed the loss there, I was scratching my head, okay, what just happened here? I bought a call option. Let's go to February here, and let's go back to the beginning here. So I bought this $105 call for $1,600, and Microsoft goes up, and I'm selling to open these weekly calls and these monthly calls, and somehow when I close out this trade, somehow I'm in the red, and I was scratching my head. And as I went through the trades, and that's important to do when you're trading options or when you're doing day trading or anything you're doing, it's good to keep a journal. I don't keep a journal because I just go through my transactions and I just add up all the numbers, and then I go through, why did I do this, why did I do that? And that's because I was under the delusion that as long as the stock goes up, if I have a call and I'm selling calls, I'm making money. Well, that is not the case, because you have to make sure that your delta is lower on the long call. I'm sorry, that it's lower on the short call and it's higher on the long call. If that ever flip-flops and you just, come hell or high water, stick with your losing strategy, then you're going to end up in my situation. And my final tally in all of this was I lost $1,067.83. So these are not the kind of videos that I like to do, but I am an option trader, and I have been doing this losing trade breaks a streak. I have been making winning trades since last August. Last August of last year was the last time I took a loss trading options, and I've been doing nothing but making money. And this is the first time that I've taken a loss since last August. That's what, 8 or 9 months or something. So, and I can handle taking, 2% or actually almost a 3% loss. It's not a game crusher, but I'll tell you what, this is completely going to change the way I trade these option spreads. And I'll tell you another thing, I'm never again going to open a diagonal spread, and if the stock moves up, just calmly roll up my short calls and think that everything is grand and roses and daisies, because it's not. If you have a call spread and it's a diagonal spread, and the wider the spread is, the more you got to be careful if the stock moves because of the delta. If you have that, you have to keep an eye on that delta. So the next time that I trade these spreads, I'm going to ratio spread it, or I might even butterfly it and just buy an extra call, buy a higher call and sell another call, something like that, and maybe close the other call. Probably I'll just ratio spread it. If I were to, let's say, buy a call and sell a call, I'd just buy a second call, so I'd have 2 long calls, and I would be shorting 1 short call, and that way my long call would more than make up for my short call, and then I would be out of the woods. One thing that I give myself credit, I learned my lessons, and I'm not afraid to take a loss. I'm certainly not going to stay in a trade that is not doing well for me because I want to be perfect and I never want to lose money. I know people that do that, and they say, well, I'm always going to make money, or I'm, whatever. And I just know that that's not reality. Everybody loses money at some time, but the key is that you always want to make more. You want your winnings to be greater than your losings. And so this year, I've done lots of videos, and I'm not going to make that 30% that I have been boasting about. I was feeling very confident because last year I made about $4,000, right? So this year I started out on the wrong foot. I'm down $1,000, but I will simply take this experience, use it as a stepping stone, and this will help me in the future. And my end game, my ultimate end goal, is to become a consistently profitable trader. Okay, so that's it for this video. Thank you for watching. If you have any questions or comments or feedback, feel free to leave in the comments. And don't do what I did. If you do an option spread, option spreads are still great strategies, and it's not the strategy's fault. It's my fault for my lack of understanding and not completely knowing what I was jumping into for why I lost money. Always take responsibility for your decisions, your option trading. So thank you for watching this video, and I will see you in the next video. Have a good day.